So, welcome to our sixth session. We are now returning to our initial topic of uncertainty. One of the strongest realization of uncertainty in recent time has been the COVID-19 crisis. So, this session is titled Monetary Policy in Latin America, Lessons from the Pandemic. We'll highlight the importance of understanding how monetary policy expanded its toolkit to navigate the crisis and mitigate a more severe economic slowdown. Our moderator of this session is Governor Julio Velarde from the Central Reserve Bank of Peru. Julio Velarde has been the governor of the Central Reserve Bank of Peru since 2006. Previously, he has conducted consultancy work for entities such as the IDB, the World Bank, the International Development Agencies, and many others. He has a long story of consultancy. Please join me in welcoming Governor Velarde and our speaker, former governor of Bank of Chile, José de Gregorio, Pepo for the Friends, who will be presenting his paper on this important subject. Please, Governor Velarde, the floor is yours.
Thank you very much. Thank you for the opportunity to moderate this session. The title is Monetary Policy in Latin America, Lessons from the Pandemic. And actually, if we see the 90s, it was almost impossible to think of a Latin American country that could apply counter-cyclical monetary policies. Just in this century, we started. And although many countries, for idiosyncratic factors, have had their own countercyclical policies, the two periods where almost all the central banks were very aggressive were during the global financial crisis and COVID. During the global financial crisis, the situation was a little bit different. Inflation was pretty high. Interest rate was pretty high. Inflation in Chile was 9.9. In our case, almost 7. And interest rates were pretty high. So actually, the reduction of interest rate, of course, was much higher than COVID. During COVID, we had an inflation of 2%, interest rate of 2.25, so the decrease, we were aggressive, we went almost to zero. But of course, the reduction compared to the previous global financial crisis was much less. Jose has been governor with me between 2007 and 2011, at the Central Bank of Chile. We faced the global financial crisis together. He invited many of the governors. One of them is here, José Uribe, former governor of the Bank of Colombia, to discuss what will happen in the global financial crisis. And at that time, different from COVID, there was more uncertainty about the magnitude of the effects. Many people were thinking it was being something close to a Great Depression. And the message there was inject liquidity. Now with COVID, we more or less expected what would happen. The uncertainty was how long it will last. Of course, we expect 3 months, 9 months, no fiscal monetary policy could have helped us to avoid a catastrophe. And we deploy a lot of weapons that are going to be explained, I suppose, by Jose. Jose not only has been a governor for 4 years at the Central Bank of Chile, previously he was Minister of Economics, and he has also a very distinguished academic career. He's actually a dean of the Faculty of Economics at the University of Chile. He has published a lot of articles, papers, books, etc. He holds a PhD from MIT. And Jose, the floor is yours.
Thank you very much. I'll stand up here. It's better because when you get nervous, you move your feet and nobody realizes that you're moving them. So thanks very much for the invitation. It's a pleasure to be here, to see again many central banks friends. When you are a central banker, you are a central banker forever. So I think that is a great opportunity. Now, in my case also, I talk about old-fashioned issues. I won't talk about digital tokens and all of that. I'll go to the basics, which is perhaps are not the same basics as 50 years ago, but I talk about the COVID, what have we learned, and I'll go this is basically, I talk something about the policies during the COVID crisis, and then 2 additional topics that I think that are quite important today. One is what's going on with inflation and monetary policy today, and in particular in the region that has done, I think, extremely well. And some other macro policy topics that are quite important, and is the financial opening, all the discussion of vulnerability, and some of macroprudential. But let me start talking about COVID. And as Julio said, when you talk about COVID, look at the watch. I always look at the watch as I will take care, but I don't take care. But it's a credibility device. So the COVID crisis. During the COVID crisis, I think that the origins were during the global financial crisis. That was the first time that emerging markets and Latin America, there was contracyclical fiscal policy, contracyclical monetary policy, and the economies performed extremely well. The last crisis in emerging market was the Asian crisis, and the Asian crisis was devastating for Latin American economies and previously the 1980s, but were devastating compared with what's happening during the global financial crisis. There we can see a bunch of countries during COVID and during the global financial crisis. Obviously, COVID was worse because we were without or working partially for many, many months, but performance was extremely well. And economies, what we see 1-2 years after the bottom of the crisis, they have already recovered. And this is to a large extent due to the policies that were implemented. And during the COVID crisis, expansionary monetary fiscal policy with a strong financial system. All the crises happened, and the deep crisis was in advanced economies, but there was no, except the usual countries with problems, but there was no systemic crisis in emerging markets. And that's because from the financial point of view, there was sound regulation, and from the macro point of view, monetary policy that implemented inflation target, and I think that quite central, a flexible exchange rate with some realism and sometimes with some interventions, but overall there was a flexible exchange rate. Now the COVID crisis brought something that was new, and the COVID crisis was, from the point of view of the economy, was a credit crisis. What's happened is that income for companies, for everybody, stopped because there was nobody working, and you have to pay your obligations, and if you don't pay them, you go bankruptcy, you have problems, and the financial system, whatever. So what central banks did all around the world, and governments, was to extend credit, and relatively cheap credit. So this should move, but should move if I press this. So this is a loans to the private sector. So we see in emerging market economies, starting 2020, they went up during a year more than 10%, and there was a small increase in advanced economies. This is quite unusual, because this is the only crisis where I have found that credit goes up. The normal thing is that in crisis, there is a decline in the demand for credit, whether it's endogenous and what's causing the crisis, there is a decline in the demand for credit. All that was needed here was credit. And here we can see, comparing for emerging markets, what's happened with growth with respect to previous trend, what happened with the rate of growth during COVID and during the global financial crisis. We see that during the global financial crisis, there was despite the recovery and all the good performance, there was a normal decline in credit. During the COVID crisis, there was an increase in credit. So I think that. And the rest of the story is well known. Basically, the policy response to the pandemic, there was a monetary loosening in the advanced economies. And as Julio said, in emerging markets, were rates relatively low. So the decline in interest rate in advanced economies went to zero very quick. So that's no wonder that they use a lot of a non-conventional monetary policy, expansion of central bank balance sheet. And in emerging markets also happened and was part of the expansion of credit, but not at the same level because there was a sharper decline in monetary policy rates. This is, although this is I want just to compare with how was the performance during both crises. During the global financial crisis, the cut in interest rate were much larger, to some extent because we were starting from much higher interest rate. There is a big issue where we were getting close or no to the neutral. But during COVID, there was a reasonable decline in interest rate, but not as big as in the global financial crisis. The turmoil during the global financial crisis, and this is also interesting, I think that also is part of what markets assess about the strength of the economies. The turmoil during the global financial crisis, we see the increase in CDS, in LATAM countries, in all emerging markets, and we see a very sharp increase in spreads. This was a very bad assessment of what's going on with emerging market economies during the global financial crisis, but they very quickly normalize. They stay a little bit higher because of tight financial conditions around the world, but there was a rapid decline. What we saw in COVID, that is then there is this is again not emerging market, then there was a European crisis, Greece and all of that mess, you remember? And this was also tightened financial conditions all around the world. And during COVID, we see that there was an increase in risk premium, but was very limited. And this is to a large extent what was the behavior and the strength of the economies at the moment of COVID. So overall, I think, with this, I want to close the look at the COVID crisis. I think that is at the core of all what's going on, and perhaps I tend to overestimate, is the role of exchange rate flexibility. I think that this is, if we would have looked and we would have shown you this figure 30, 40 years ago to some economists from Latin America and said, this will be the fluctuations on currencies in emerging market economies in Latin America, they would say it's impossible. All firms will go bankruptcy. The governments that are highly indebted in dollars won't be able to pay, and there will be a collapse. So what we see in the left-hand side, starting 1 year before the global financial crisis, sharp depreciation. I have added also some, with the dotted line, some Asian countries, because they also went through similar patterns, not exactly the same, as also always Peru is the only very stable country. I would still don't understand why, but it's very stable. It's Velarde, but it's a change rate. But there was a sharp appreciation. Then comes Europe, and where the appreciation were not that large, despite the very strong dollar and the price of the dollar. But there was a depreciation more limited, no crisis in most emerging market economies, and I think that this has been key to navigate relatively safe during the turmoil without spillovers from forex markets to the real economy or to the financial system. And this is what I want to, in the next slides, to show a bit more about that. So what we inherit from the COVID crisis was very strong expansions, fiscal expansion, monetary expansions, all around the world. Supply bottlenecks, problems with the distribution chain and trade. So there was a supply disruption, demand expansion. That's inflation, and we inherit very high rates of inflation from the COVID crisis. Now, again, when one looks at Latin America, one would say rate of inflation that went between 2 and 4% and went up to above 10% in most countries to 14, 15%, you would say, looking at the past, this is if you would take it time series, it will take 10 years, or many countries will stay with high rates. And what we saw was a very rapid reaction of monetary policy in Latin America. The gray line in the right panel is the Fed that start rising rates like 1 year after Latin American economies. Latin American economies start in mid-2021, raising rate very sharply with a lot of concern and controversies that may have from the political point of view, but that's very good because central banks are independent, and what we have seen is that inflation have come down, as we would have expected. The output costs have been quite limited, and the disinflation has been quite successful. Still, we haven't reached long-term, the pie star or pi bar, as you want to call it, to long-term target. Still, the inflation persistent has been a little bit longer. All inflation target framework said a couple of years to return with the inflation to the target. It has taken 2 to 3 years, and still we are not in target. Those are discussions that we may have in the next Chapultepec conference, and many discussions that we economists want to have to meet us from time to time. But from a deep point of view in the countries, the issue is 1 or 2 points of inflation, but has been extremely successful. Two things that I would like to talk, and I think that are quite important and were also important during the last crisis. And the first is risk sharing and exchange rate in emerging market. This is something that we grew up saying, if exchange rate depreciate a lot, the government will go bankruptcy because they borrow in dollars, they cannot borrow in their own currency. There is original sin. At the BIS, some work intensive that we has been also done on this issue. But all of this came looking at the Chilean experience. And I think that's quite fascinating because it's extreme. Chile had a revolution in October 19, we can say, was social unrest. It was close to a revolution that now we can say was social unrest because the revolutionaries didn't take power and there was no guillotine, but we were very close. Okay, we had a huge social uprising in the last quarter of 1919, and what we saw during that period, okay, from late 1919 to late 2021, was that the net international investment position, the blue line, went from minus 15% to 5% of GDP. So during that period, we received a transfer from the rest of the world of 10 percentage points of GDP. On top of that, 15% was was from 40 to 15 was 15%. The net international investment position declined. Okay, was 22 minus 5. But the current account deficit was 6%. So you have to add that to compute the price effect due to the exchange rate depreciation and the decline in the stock market. Basically, we are short in our equity and we are short in pesos, and the rest of the world takes part of the adjustment. And it was a sharp a transfer from the rest of the world to Chile in extremely difficult moments, but that's what we call insurance. So the issue was how this worked for the rest of emerging markets and how this happened. So basically, I will show you here a summary from a paper that I have with a colleague, which is basically this is the net financial weight. Basically, this is a number that when it is above zero, a depreciation of the dollar reduces your net international investment, increases your net international investment positions, you gain. When it is negative, you are short in dollars, so you lose with the depreciation. This is basically, so it takes what the fraction of your asset and liabilities are in dollars and compute that weight. What we see is that since the late 1990s until roughly 2006, 2008, this was improving. And this also coincides with the period of financial opening. So in a way, financial opening was also a way not to go to get more vulnerable, but to get insurance and hedging. So this is, it had changed my way to see many of it. Then it stabilized, okay? But what's happening today, an exchange rate depreciation for countries improved. This is like we used to call this for the US and for advanced economies, but also happen is that we don't have negative wealth shocks with the depreciation. So the depreciation helps on the trade balance, but also helps on the net international investment position, so we would be enjoying some sort of exorbitant privilege. These things that has been long discussed for the case of the US, and I think that has been quite an important development. There is heterogeneity across countries, but we see, and this is consistent with the story that we have had sharp depreciations and no emerging market, well, except Turkey, Argentina, well, there are always countries, but normal emerging countries had suffered significantly from this. And finally, this is, I think that is very, things that I have been, this is still in a work in progress, but it's macroprudential policies and capital controls. The purpose of both of them, from the financial point of view, they may have many objectives, but it's to tighten, to tighten financial conditions, to reduce credit, and well, that's the idea of the macroprudential, and it's to control credit booms and all of that. So basically using, this is what's going on in the world. We see that capital controls are relatively stable for the last 20 years, so there hasn't been a very big change in this sample of countries, but there has been much more the use of macroprudential tools. So what I will show, basically we want to know whether capital controls, that was our H0 hypothesis. We said, well, capital controls and macroprudential tools should increase credit constraint for economies, and for firms, and because that's what this measure wants. And the way to see it is just to see, this is a very old, well-known thing from Fasari and Harvard. You take the investment and you control for cash, and cash is an indicator of how important are a credit constraint for investment. So then you interact this with the policies, and you say, well, this is positive. And what we see is basically the first line, capital controls increase the importance of cash affecting investment, so it tightened financial conditions. What we surprisingly found is the other way around for macroprudential policies. They don't tighten financial conditions. And this is a long discussion. We separate between macroprudential, the F is macroprudential tools that affect the financial system, capital requirement, and those sort of things, that they don't have effects. But what we found is that those that affect borrowers, mainly loan-to-value ratios, those affect positively the rest of financial constraints. So we think that there is, and we discuss more that, we think that there is a substitution effect. So banks and financial institutions start reducing lending to households, but maybe increasing to corporations. So those are things that we're thinking now, but I think that's quite important, basically because we're thinking how to have tools to affect financial stability, because to promote financial stability, because we know that that's one of the big Achilles heel of the business cycle in emerging market economies. So with that, thanks.
Thank you very much, Jose. Maybe one point that I will try to address, it was not only credit provision, it was guarantees by the government, which were guarantees by the government for the loans were extremely important. Otherwise, the banks would have not lent in spite of providing liquidity.
It was fiscal and
the banks knew they had to lend, but they were afraid of lending, of course. No? And there has been a difference between the countries, how they provide these guarantees and credits. In the case of Chile, you gave a 4-year credit being paid after the 4 years. And you adopted a fixed rate of 2.5, if I'm not wrong. In our case, we have also 4 years, but they have to start repaying after the first year. And also, the rate was through a bidding process. The banks took a portfolio, let us say, 500 million for these clients. We will ask for these clients 1.2%, let us say, a year. For their client, 1.5. At the end, the rate was lower than those fixed by the government, like in the case of Chile. But my sisters, this is very hard. Where I'm afraid, and I have seen something, at least in Peru, the government and Congress believes that it can be permanent. Of course, we have not taken part in any other program. Even the refinancing of these programs were with the money of the banks. We provide liquidity to the general system, but we didn't provide for any specific loans anymore. But the government has created a lot of new programs, also giving guarantees. Have you seen that in Chile, also a pressure for more of these type of loans?
That's very interesting because we did start with the application of this credit guarantee were different across countries.
Sure.
In Chile, even there was some facilities of the central bank to private banks, but they were contingent of that they were lent to corporations. So there were many variety. Now, you're completely right. This is a typical problem in public policy and in fiscal policy. You provide a guarantee for COVID, and then you say, well, but let's keep going. Because also they say because it has worked.
Yeah.
In the case of Chile, it was a law with a limit, so it ended, and there was no more pressure to go with that. Despite even, I think that there is also tension with the hiking, with the tightening of monetary policy that should create more incentives for firms to ask for guarantees. Now, in the case of Chile, there is also a very old tradition of a very small and credit guarantee. So you can say we can get rid of those because you still have those that are for small and enterprises.
And that problem that you addressed partially was, I remember Hausman, 2001, I believe, no? He talked about original sin. Original sin was the inability of emerging market countries to issue debt in their own currency because there was no credit in fiscal policy, risk of default, no credit on monetary policy, risk of inflation. But at the same time that this name was getting popular, we were issuing more and more debt in domestic currency. But now the problem I see in many countries in Latin America is the risk of fiscal dominance is becoming more and more important. I still see a lot of credibility in monetary policy, but I see less, not enough, but less credibility in fiscal policy than 5-6 years ago, no?
Yeah, that's also quite important because it is true. Now there is the governments, they borrow, they don't need to issue in New York, but they issue in domestic currency, and there are a lot of foreign investors that wants to lend. Now the problem, I think that this is interesting. I don't have made completely my mind now. But after the COVID crisis, we ended with a very high public debt all around the world. Interest rates are still low, but I would say it's one of the main macro risks that economies face today is that public debt in the last 15 years have been rising non-stop, and it had a lot of fragility. However, and this is the part that I would like to, however, there is also this idea that there has been fiscal dominance, that to a large extent, the last inflationary spike was caused by fiscal dominance. And this is Barrow and some quotes that they have been. And part of the inflationary period that we had the last couple of years have reduced the real value of debt. I would like to look more at the numbers, but I think that that's something that wouldn't make so high the levels today, but I haven't seen carefully at the number. I think that the BIS can do it.
Well, thank you very much. We open the floor for questions. Please, Alexandre.
Thank you very much, Pepo. It's great to try to learn the lessons from this recent economic shock. One thing I think you mentioned here, the countries in Latin America have responded, have started raising rates in early 2021, while during that period you have very important advanced economies that were still debating whether the shock was transitory or not, and I mean, emerging markets don't have the luxury to wait and see, as we know. But what's your view on, do you think perhaps the central banks went too far in responding to the COVID, in cutting rates in the first place? What's your view with the benefit of hindsight now?
Yeah, that's it. I always have to, one is the discussion that we can have in a group of economists and say, well, they many times I say, well, perhaps the Central Bank of Chile should have been not that tight or could have waited, and then we go to Brazil and say, well, they're hiking. Overall, it has been impeccable, I think. There is an issue about timing, but this issue about timing has a lot to do with how you view monetary policy, where you have to raise rates in a consistent way and not to wait a month and then in another 2 months, because it creates a little bit of volatility. So there are issues that perhaps on a month-to-month basis we can discuss. Perhaps sometimes monetary policy may go a little bit far, and let's say, well, it may cost output 0.5 percentage point of GDP, things like that. Yeah, could be, and this is country by country. But overall, I think that has been extremely good. Most countries start raising rates very much in advance, which needs a bit of courage because it's very easy to raise rates after the Fed has raised rates. But you start a year before, and then inflation starts coming down, and there are no big concerns in countries about the control of inflation. We have in Latin America, and in particular in Chile, inflation has been politically very costly. Otherwise, ask Biden. But this is because if prices go up, but they don't go down, they stay up, and you control inflation. Now, we have also the advantage in Latin America that we can blame Biden too, and the expansion of fiscal policy around the world that caused us to have more inflation. In the case of Chile, we have another excuse that also is very useful to say people, you know, when you do silly things, is that we had 3 withdrawals of pension funds in Chile that were extremely damaging, and people receive a lot of money, and we say, well, that was cause inflation, and so people now is, so we learn. And so I think that there has been, still we need to reach a target. Okay, that's fine, but overall has been extremely good, I think.
Some question, please.
Yes, thank you. About your last point on macroprudential and capital control, or CFM. I actually happen to have a very similar research going on, and I fully sympathize with you about your point on leakage. You tighten housing credit, then it can shift to corporate or some other forms. And I guess that sort of, in a sense, challenges this traditional view that if you tighten macroprudential and CFM at the same time, they should have a better outcome than only do one or the other. Because leakages can happen in different ways. For example, you tighten macroprudential and then capital banking inflow may actually increase because banks may want to borrow not from domestic but from foreign sources. And CFM may help, but may not help enough because now there's a spillover effect. So in this kind of circumstances, what do you think is the best way to combine the two? Still, there are a lot of sort of complex leakages.
You say with monetary policy, with the
monetary policy given fixed. I mean, if monetary policy also added, that's another dimension. But assuming the monetary policy is going the same direction.
You want to combine
macroprudential and CFM. How do you
and
capital control? Yeah, because eventually these two can be used at the same time. Yeah.
But I would say more in general. You want to be contractionary all the way with all the tools. It's kind of contradictory to say, well, I will take care with macroprudential. I will take care of the financial fragilities, but also reducing interest rate in monetary policy. So I think that there has been consistency. Regarding capital controls, I have become, with my own research, very skeptical about capital controls. I think that they shouldn't be used. I think that first, financially opening is good, and this is, and second, it gives you, this is policy and experience, because at the beginning when Chile started applying capital controls, I was in the government, the finance ministry, so I had to be a good soldier, and I say that they were excellent too. But then when you think more about that, capital controls, and this happened also in Brazil, gives you the impression that you are isolated, that you can hike interest rate as much as you want because you control capital inflows. And that doesn't happen. And that's what causes an appreciation, a lot of inflows, and I think that they are not that effective. I believe a lot in having a strong financial system. Microprudential tools, whatever, we have to be very careful. But thinking about capital controls, a way to avoid capital inflows, I think that they are not very effective, and it creates this idea that you are isolated and that you get rid of the trilemma, and no, that doesn't happen.
Well, we have time for our last question. Yes.
Thank you for the presentation. You have shown us clearly now that central banks in the region have been able to run countercyclical policies. My question is if you think some of the countries are ready now to run policies not that are countercyclical, but that go counter. My question is if countries are ready to, or some countries in the region can run policies that go counter the Fed. No, you have shown us that now countries can experience very large depreciations and there is no significant pass-through, no significant episodes of financial instability, but still many central banks are afraid of going to differentiate strongly from the Fed, even if local conditions warrant that, because there can be an episode where foreign investors run away from government bonds. But my question is, countries that have low current account deficits and that have deep capital markets, no? Like Chile and like Mexico now, are they ready now to distance from the Fed and knowing that maybe you're going to have capital outflow, but you have a deep enough capital market that can counter that exit and that governments can finance their deficits with local markets, or the region is still trapped and binded by what the Fed does?
I have problems with the sound. That is,
maybe I can say partially, because actually Chile and Peru has rates below the Fed before the global financial crisis for almost a couple of years. I think in Thailand has a rate of, and the 10-year bonds are 2.9, something like that, no? So you can do it. Probably we might need somewhat more credibility, but we can do it. Actually, when I'm thinking about reducing the rate, I'm not thinking so much of the Fed, as the market believes, no? Probably we cannot go much down. Probably we're not Thailand yet, but probably we can be below the Fed without much damage, let us say, no? But
I have two concerns about that. First, we have deep financial markets, there is a capital flows, arbitrage, and with all the things, and Mexico and Brazil much bigger capital markets than many other countries. There is one thing that I think communications in central banks is quite important. So I think that when a central bank starts saying, well, that there may be a concern because our rates could be lower than the one of the Fed, I think that that's a mistake, first. Second, there is no reason why there is kind of a threshold. So if we get to the Fed, then there is a collapse. And it's kind of whether you put the zero, it doesn't matter. Life is a continuous. So I think, and this has created a lot of, I would say, again, it's a short-term turmoil in our markets because you say, well, will they cross or no? So I think that communication is very important. And this was one that somebody told me when I was at the central bank, you are cutting rate too fast and the dollar could go up, but who cares? I said, that was kind of my answer. Was a little bit blunt, but it's a, so I think that, and the second is the deep reason. We are interconnected. There is arbitrage. When interest rate moves, exchange rate moves, but that's the adjustment. And let's not exaggerate the adjustment. because if you change 1 year rates by 1 point, well, you may have to add a lot of noise to have a depreciation of more than 1%. So so markets move a lot in the short run. Sometimes central banks have to intervene, but I think that having very interconnected markets hasn't changed at all the capacity of central banks to do policy and to do whatever they want, I think.
Well, no, we have no more time, so thank you, Jose, very much.